Welcome to Kenanga Research. My name is Sarah Lim. In this segment, we will review the reporting season of 1st Q14. Results were actually mixed in nature, with results coming in either within or below expectations. Out of 128 stocks that we cover, 60 stocks actually came in within expectations, while 27 stocks were actually above expectations. The remaining 32% of stocks actually came in below. This disappointing ratio has yet to improve significantly as opposed to the previous two reporting seasons of 34% and 5%. On average, we saw a 6% to 7% downgrades in current and next year's financial earnings as the accumulated FY14 net profit merely grew 2% year-on-year on average. Post-results, our FY14 to FY15 core net profit growth estimates for the FBM KLCI were revised to 11.8% to 10.2%, in contrast to our earlier estimates of 13% to 8.7%. Out of the various sectors under our coverage, the auto sector was the clear-cut loser as auto companies under our coverage delivered weaker than expected results. This performance trend was somewhat similar to the previous reporting season. The auto sector saw downward revisions of 9.5% and 4.8% on average and in FY14 and FY15 estimates after already being downgraded by 7% and 3% in the previous quarter. At the same time, plantations, transportations and logistics, utilities were actually broadly within our expectations. However, sectors that were overshadowed by mixed to negative tones were actually construction, consumer including the F&B, retail and sin subsectors, oil and gas, and property. Despite lacking of re-rating catalysts, we still see a higher FBM KLCI index target as analysts have started to roll over their valuations base year to FY15. We actually derived a higher FY14 index fair value of 1915 from previous 1890. This actually implies an FY14 PER of 19 times. Our index target is derived from a combination of top-down approach, which yields a target of 1830, and a bottom-down approach that yields a target of 2000. Our FY14 index fair value is slightly below the consensus index target of 1950. This index target is also backed by current year and next year's earnings growth rate of 22% and 9%. While we do not rule out that the FBM KLCI could surpass our index fair value to form a potential high of 1970, the short-term upside could actually be kept. In fact, the recent market correction from the high of 1889 are actually within expectations. To recap, based on the discount trend of the FBM KLCI to consensus index target, the FBM KLCI could become toppish if and when it trades at a minimum discount of 3%. The FBM KLCI tends to pull back at this sharply overbought territory. For now, the index seems to have staged corrections and could be in the midst of swinging towards the 1830 level, which is the average discount of 6% to the consensus target despite the improved foreign net buying activity. Recall that foreign investors have been net sellers since mid-2013, in line with the weakening trend of the ringgit against the dollar. However, they have turned into net buyers as of early April. Having said that, we believe that the downside will still be supported as the liquidity of the domestic financial system remains robust. In conclusion, we still prefer a buy on weakness investment strategy. The ideal buying level should be less than 1835 or a 6% discount to the index target of 1950. I'm Sarah Lim. That is all we have for this segment. Till next time, have a good day.